In 2025, we're watching something extraordinary happen. Something that's been brewing under the surface for years. The convergence of traditional finance and crypto is no longer hypothetical. It's here. And it all started with fun thing, stablecoins, the ChatGPT of crypto. They were the first to go viral. They reached the people. And now, they're reaching the banks. Stablecoins were crypto's ChatGPT moment. Why? Because like AI, they made blockchain useful in a practical, seamless way. Consumers use them for remittances. Businesses use them for cross-border payments. Developers integrate them for yield, liquidity, and DeFi infrastructure. And now, banks and institutions are finally catching up. Visa is settling transactions in USDC. PayPal has its own dollar-backed token. Stripe uses stablecoins to pay out globally in seconds. This isn't just adoption, it's infrastructure. Stablecoins are quietly becoming the TCP/IP of modern money. This is no longer just crypto-native players moving money around. JP Morgan has launched its tokenized collateral network. Goldman Sachs is working on issuing its own stablecoin. BlackRock is investing in tokenized treasuries. And where is it all happening? On Ethereum. Not private blockchains, not simulations. Ethereum Layer 1. Because it's programmable, permissionless, and increasingly secure, Ethereum is becoming more than a crypto network. It's evolving into the architecture for future banking. Think about it. If Goldman Sachs or JP Morgan wants to issue stablecoins on Ethereum, they don't just want exposure, they want control and security. That means running validator nodes, that means staking ETH, that means securing the very infrastructure their digital dollars are moving on. This flips the old relationship on its head. Instead of banks issuing on their own rails, they're plugging into open networks and securing them economically. Stablecoins backed by yield-generating staked ETH. ETH becomes the base collateral. It's staked, meaning it generates yield while securing the network. That yield helps offset volatility, gives institutions ROI, and aligns them with Ethereum's growth. This is a shift from debt-based collateral to yield-generating neutral digital native collateral. It's not treasuries, it's not dollars, it's Ethereum, and it's programmable. Imagine a crypto-native treasury bill built on Ethereum. You deposit ETH. It gets staked. A stable coin is minted against it. The yield flows back to the holder or the protocol. This isn't a speculative product. This is programmable fixed income, an interest-bearing, highly liquid instrument built into the chain itself. In other words, the next generation of financial tools won't just copy the old system, they'll improve on it.
But what we've seen in the last, really in 2025, is the financial services industry and crypto are converging. And it really started with stablecoins, which is the ChatGPT of crypto, right? Because it's viral adoption by consumers, businesses, banks, and now even Visa. The more Ethereum that's accumulated, the more secure the network is. And I think it's also sort of the architecture that future banks will have. You know, when Goldman issues a stablecoin and JP Morgan doing it on Ethereum, as a layer 1 blockchain, they're going to want to secure it by staking Ethereum. So we're trying to get in front of that by creating a treasury vehicle.
If ETH becomes the base layer for financial infrastructure, the collateral, the security layer, and the yield generator, then institutions have every incentive to accumulate it. More ETH staked equals more secure network, equals more trust, equals more activity, equals more fees, equals more value. It becomes a positive feedback loop, one where ETH is no longer just a token, but a new form of capital stock. In 2025, we're not watching crypto replace banks. We're watching banks become crypto native. Slowly, block by block, stablecoins are the gateway. Ethereum is the backbone. And staked ETH? That's the Treasury bill of the future. When stablecoins scale from $250 billion today to $2 trillion over the next few years. That's not a wild prediction, it's just institutional reality catching up. At $2 trillion, stablecoins wouldn't just be a crypto innovation. They'd be a pillar of the global financial system. And here's the wild part. At just $250 billion, stablecoins are already the 12th largest holder of U.S. Treasuries in the world. If they scale to $2 trillion, they could become the single largest holder, bigger than Japan, bigger than China, bigger than the Fed's foreign counterparts. That's not just a crypto milestone, that's a geopolitical shift. This isn't a threat to the US dollar, it's the biggest gift the dollar's ever gotten. Let's break down US dollar dominance right now. The US is just 27% of global GDP, but it makes up 57% of central bank reserves, 80% of global financial transactions still settle in dollars, and 100% of stablecoins. That's right, every single major stablecoin is denominated in dollars. So what does that mean? If stablecoins grow to $2 trillion and they're still all in US dollars, then you're locking in digital dollar dominance for the next generation. Stablecoins are like digital satellites of the dollar, orbiting around the Ethereum ecosystem, but always pointing back to Washington. That's huge. It means global dollar access without needing US banking licenses.
Let's say stablecoins, which is $250 billion today, gets to Treasury Secretary Bessent's reasonable $2 trillion. That's a 10 times increase in size. By the way, already stablecoins are the 12th largest holder of treasuries. They'll become the #1 holder by then. US dollar dominance is 27% in GDP terms.
Stablecoins don't live on spreadsheets, they live on blockchains, and Ethereum is the settlement layer of choice. Every transaction in a $2 trillion stablecoin economy generates network fees, validator rewards, and MEV opportunities for Ethereum participants. We're talking billions in annual fees paid out directly to validators and stokers, no middlemen. The more dollars move through the crypto economy, the more Ethereum gets paid. This is what we mean when we say ETH is monetizing trust. Ethereum doesn't just support stablecoins, it scales them. Every time a stablecoin is minted, moved, or redeemed, ETH gas gets burned. Every time a transaction settles, validators earn rewards. As usage increases, ETH supply decreases, driving up value. You're turning Ethereum into a global engine for dollar transactions with real cash flows. And as stablecoin demand increases, the demand for Ethereum block space and security follows. What Visa and SWIFT were to the 20th century dollar, Ethereum is becoming that for the digital dollar in the 21st. What we're seeing now is just phase 1. In phase 2, stablecoins become programmable. Payroll runs on-chain. Trade finance happens without banks. Governments use stablecoins for stimulus. Emerging markets skip correspondent banking entirely, and it all clears through Ethereum, Layer 2s, and modular roll-ups. The dollar becomes a smart dollar, and Ethereum is the clearinghouse. Think about that. Ethereum turns the dollar from a static unit of account into a dynamic software platform. That's the future of finance. So this isn't crypto versus the dollar. It's crypto securing the dollar in the digital age. A $2 trillion stablecoin market ensures dollar dominance. It also supercharges Ethereum's economics with more fees, more staking rewards, and more demand for ETH. It's a rare moment in finance, a win-win for America and the blockchain.